Hello, and welcome back to the Accounting Podcast, the number one podcast for accountants in the world, your weekly news roundup in the accounting profession. I'm Blake Oliver.
And I'm David Leary. And Blake, every time you hold your arm up, it looks like you're holding an additional microphone. What is going on here?
It's my hand brace. I broke my hand, David, this week.
When you heard about that BOI was back on, you slammed your hand on the desk.
Yeah, I was running to file our BOI report on what was it, December 23rd, just a few days ago, when the Fifth Circuit Court of Appeals granted the government's emergency motion to stay the injunction for BOI, which reinstated the reporting requirements. And then I heard yesterday that the same court vacated the order, and I stopped really fast. I was about to go fill it out, and I stopped, and I fell. I was on my bike, and I broke my hand. So thanks a lot, Beneficial Ownership Information Reporting. I was riding my mountain bike. Of course, it had nothing to actually do with BOI, but we're going to talk about that today. We are going to talk about BOI's on again, off again situation. What is happening with that? Breaking news. We've also got Bench shutting down. Accounting startup Bench announced that it is closing its doors with very little notice.
Just
as of this morning.
A couple hours ago.
Thanks, Michael Lee, for sending us that. And we'll talk about that. I got some Billy Long stuff, the new IRS Commissioner. Welcome, everyone who has joined us on this Friday, December 27th, as we head into the new year. Good number of you in the office, I take it. In the home office, perhaps. Great to have you all with us. David, how are your holidays going?
Pretty good. A lot of recovery. I had a little minor back surgery, so both of us are hobbling a little bit right now with injuries.
Yeah.
I had a microdiscectomy to try to pull a disc away that was pushing on sciatic nerves. If you watch really closely some of our previous episodes, you might see my face wince in pain occasionally on some old episodes standing here, but I think I'm doing okay, all things considered. I'm not on any drugs anymore. No more pain meds, so I'm tapering off.
Unfortunately, I'm going to have to get surgery on my hand, so that's my New Year's. That's what I'll be doing. I'll be watching the fireworks at home on painkillers, I hope. Welcome, Luke. Luke says, sad day. Lots of people who need jobs and bookkeeping and tax. Yes, regarding the Bench shutdown. And we'll talk about that. But first, let's talk about Beneficial Ownership Information Reporting, BOI reporting. So like I said, it is now on hold. The nationwide injunction that pauses BOI reporting requirements is back in effect. So there is currently no requirement to do so, to file. And I think, David, it's a good thing I didn't do anything yet. I didn't make it to actually file because we're just gonna hold. We're gonna wait.
We put it on our to-do list and took it off, then put it back on again because I thought for sure we had to do it this time.
Yes. And a quick, go ahead.
I said it's been an interesting month because we talked about this way back in March of last year. I was looking back at our old stories. That's when it was declared unconstitutional. So way back in March of 2024. It was
but in a very narrow way. It was an Alabama federal court, and it was a limited injunction only applying to the plaintiffs in the case, which were the National Small Business Association and its members. But that was the first hint that something might be coming bigger than that.
And so it's been this dance. Not a lot of people have been filing it. And then December 3rd, we actually talked about this, 2 weeks ago? We named the episode when BOI was off. It was dead. And then I think during the compromise on the shutdown, there was some BOI FinCENT news in there. But just this week, so December 23rd, they lifted the injunction, reinstating the requirement. So as of December 23rd, we were supposed to file again. And then as of December 26th, which was yesterday, they reinstated the injunction, pausing the requirement to file. But as of right now, the deadline did get extended from FinCENT to January 13th. If you actually have to file, it's now a January 31st or 13th deadline instead of
right. But we don't have to file.
There's no filing as of this second. Correct.
Right. So there's where we're at. Yeah. Hopefully we don't have to do this. As I've said on the show before, I feel like this law is unconstitutional, just given how broad it is. An LLC that only operates in one state should not have to file with a federal agency based on the Commerce Clause in the Constitution. It just doesn't add up for me. But we'll see. We'll see what the federal courts think. Maybe this will go to the Supreme Court. We'll find out.
FinCEN should have pushed this out to January 21st. So then they could have had maybe Trump put this on his little day one agenda. He could
to shut down?
Shut it down, yeah.
I'm pretty sure that the bureaucrats at FinCEN are not in favor of shutting down the program they've worked so hard to create. That, of course, will not detect any fraud. You know, the funny thing about it is, and this is why I tell accountants not to stress about this, and business owners too, is that to be eligible for these fines of $500 a day, whatever it is, which seems ridiculous, it has to be willful. You have to willfully misreport the beneficial owners. So that means legally, it means you've created like some sort of trail, evidence that you intended to get it wrong. So as long as you just do your best effort, you're most likely going to be fine, right? That's what FinCEN has said in essence, is just do your best. It's like 1099 reporting, right? When was the last time anyone got in trouble for doing their 1099s wrong? You get in trouble for not doing them. You don't get in trouble for the wrong amount or the wrong payee or like getting somebody's TIN wrong. I mean, I've seen TIN mismatch numbers come back from the IRS for years and years and nothing ever happens. So just do it. All right. Welcome, Drew. Drew says, hi, dudes. Starting my second busy season internship in a short couple weeks here. Wish me luck. I need it. You're going to do great, Drew. Good luck. Sean says, good luck, Drew. I'm working 2 jobs now. I'm both in accounting, so I feel ya. All right, let's talk about bench.
Yeah, and that's good. So Luke Fry, CPA, who joined us in watching the live stream on LinkedIn, he actually was Bench's first accountant.
No way.
It's nice that he's in the audience here.
Wow.
And then I think after that he went to Pilot, and I think right now he's at Puzzle. So he's had a lot of experience in this. So Luke, it'd be great if you could chime in on some of your thoughts. What are the reasoning for this shutdown at Bench? Be great.
Here's the homepage of Bench, bench.co. Notice of service closure. So it's right on the homepage. We regret to inform you that as of December 27th, 2024, the Bench platform will no longer be accessible. We know this news is abrupt and may cause disruption, so we're committed to helping Bench customers navigate through the transition. From the entire team at Bench, it has been an absolute privilege to serve small businesses for the last 13 years. Thank you for being part of our journey, the Bench team. And then there's a timeline of what will happen next. They're saying that by December 30th, customers will receive further information about how to access their Bench data. They are recommending Kick, a modern accounting software, to, I guess, continue doing your bookkeeping to get support. I don't know what Kick is. And then there's some frequently asked questions. Do you have any information about Kick, David?
Yeah, so Kick is accounting software that does the work for you. So it's a new startup that recently took money as well. They're using a lot of AI. It looks like bank feed accounting at the end of the day. It's startup bookkeeping, if you want to call it that. They have about 1,000 customers. But the fact that they're offering a discount for Bench and these ducks are in order, and they basically have a landing page for the Bench people to come over, tells me this wasn't something Bench decided this morning to shut down. Obviously, there's been chatter or talk about this with the Kick people to refer them over here. Kick's prices are pretty low compared to what Bench was. I had to go to Bench on the Wayback Machine to go find the old Bench website. And Bench's prices were up there a little bit. Where were they at? It was $299 a month or $599 a month, depending on if you wanted bookkeeping or bookkeeping and tax. So it wasn't like they weren't doing it for $50 a month like a lot of these startups were trying to do. They were charging arguably a normal monthly CAS fee, $300 a month.
Bench was a bookkeeping firm, an accounting firm. They even did taxes, right? Luke says Bench was in Techstars and the messaging was to, quote, automate bookkeeping, unquote. They pivoted and ended up just going to a cheap way to deliver Labor arbitrage in Canada, salaries are lower, exchange rate benefits the US. And Rafi says, who would have thought charging only $100 to $300 a month for bookkeeping is not profitable? Well, Rafi, I do think it can be, and there are companies that do this at scale. They have thousands of clients. Bookkeeping Express, BKE, would be an example of that. They're doing well. They're profitable, right? Keith Mueller. I believe Keith Mueller when he says that, CEO there. I think my guess is that if I have to speculate on this, David, I'd love to hear your thoughts, is that bench over leveraged, or they in startup land, they spent too much on customer acquisition and they couldn't make the economics work. And usually the reason it doesn't work is because your costs are high, you have high cost of goods, and this is what happens when you're running a service organization, and you have high churn. You have high churn both on the COGS side of things, the bookkeepers that you are hiring, and then you have high churn on the customer side. And if you're spending a lot of money on digital ads and partnerships to acquire customers, you're paying a lot of money to advertise to acquire customers to grow quickly, and the churn is high, you just cannot get that lifetime value above what you're spending to get those customers, and you run out of money.
My understanding is there's a lot of churn. You talk to other accountants, they get people from bench. They're constantly having to get new customers to keep the model going. And Luke could confirm for us in the chat. It'd be great if that's actually true. Now, what's amazing about this is bench, they raised over $100 million to build this as a business. And the early days of basically the business, the theory was they had bookkeepers here in one room, and the room next door are engineers. So every time the bookkeeper has to do something, the engineers watch, figure out how to possibly automate it. That was the bet. That's the concept. You're going to automate the processes and the bookkeeping to make it super efficient. I mean, we've seen this story over and over again. But so as of in 2021, when they were about 9 years old, they raised $60 million in their Series C. And what I'm thinking is, how did it take 13 years for this model not to work? Right? Were there any signs?
They kept raising money.
They kept raising money. But when you start doing Series C and you start doing the rounds after that, that means you're on the march to become a real company and to go public, possibly, right? Have an IPO.
Well,
where's the due diligence of, is this a business? That model should have been vetted out earlier, is my point of view.
Well, there's a misunderstanding about automated bookkeeping in the tech world, in the VC world. It's sort of like, I don't know, it's like Uber in a sense, in that what you're betting on is if you invest in Uber, you're betting on Uber figuring out how to get rid of the drivers.
Yeah.
And bench didn't figure out how to get rid of the human bookkeepers or to leverage them quickly enough. So their costs are simply too high to support a SaaS business model.
Because I'm paying bookkeepers and I'm paying engineers, which is the worst model. I'm paying double the cost.
Exactly, the R&D, right? So if you're a software company, your cost of goods is hopefully like 10, no more than 20%. And so you have really high margins, or you have a really high gross margin, and then you can invest in R&D, and you can take money from investors to then invest more in R&D. But bench also had this really high cost structure. Even being in Canada, they would have been way better off doing this offshore in terms of cost structure than in Vancouver. I mean, sure, I guess Canada's a little cheaper, but like Vancouver's a very expensive place. So I have a hard time imagining that with an office in Vancouver with people coming in, they could make this work. Somebody commented here in the chat about like their firm not being able to do it. Yeah, Sean said, the firm I'm moving to, working on at the moment, doesn't even think about you before $500 a month. And my experience at a mid-sized firm in LA was that we couldn't serve a client for less than $1,000 a month. It was really hard to make the economics work. So unless you're doing it somehow with like offshore labor that complements the automation that you're building, this is just not going to work from a cost standpoint. So it's kind of sad because I mean, it is sad, and I feel sorry for the folks at Bench who are surprised by this, the people who are going to lose their jobs. They have over, sounds like 650 employees, and they serve over 10,000 business owners. I'm seeing numbers like anywhere from 10 to 30,000. And that's a lot of people now who are just like, busy season's coming, tax season is coming, and they may not have their books closed. They may not have their data. Who knows?
And they were helpful for customers that were using them successfully. I saw a quote about their partnership with FreshBooks. So when FreshBooks would get somebody to sign up for Bench, they would not turn off of FreshBooks. They would stay on FreshBooks, 80% more successful, essentially, by having an accountant helping them at Bench. So and I'm not seeing nightmare stories like we've seen with some of these other startups that have folded, these bookkeeping plays that have folded on Twitter where, I found out they didn't file my tax returns for 3 years. I'm not seeing those types of nightmare stories online other than people, hey, I just signed up, this week, I paid for a year of service and now they're shutting down. Now what? Some posts like that on social, but I'm not seeing a lot of accusations of complete incompetence happening at Bench, which we've seen in the other previous scale factor. We saw that with some of these previous startups, Pfizer, Tax.
David, let's take a break and thank our sponsors and read our first sponsor message.
Yeah, so our sponsors today is LiveFlow, Shurink, Cloud Accountant Staffing, and Tax Bandits. So we'll do the first ad for LiveFlow here. Are you a QuickBooks fan or do you prefer Xero? Well, I've got some exciting news for you. LiveFlow now syncs QuickBooks and Xero to Google Sheets and Excel. You might already know that LiveFlow has been a game changer for thousands of accountants and their clients, automating financial reporting from QuickBooks Online to Google Sheets. But if you were an Excel user or on Xero, you were kind of left out until now. Here's something that'll blow your mind. You can create consolidated reports for clients who have one entity on QuickBooks Online and another on Xero. LiveFlow can speak to both at the same time, and your reports and custom dashboards automatically sync in real time. Also, there's even more LiveFlow news. LiveFlow now has dashboards built in, so instead of you having to create charts and graphs from scratch in Google Sheets or Excel, LiveFlow gives you the ability to create beautiful, customizable dashboards for your clients. You can even give the client a PDF as the dashboard is a PDF, that's your client's thing. If you're ready to take your financial reporting to the next level and to get 25% off your first 3 months, head over to accountingpodcast.promo/liveflow. That is accountingpodcast.promo/LIVEFLOW. Thank you, LiveFlow.
Thank you. So, did you see the news about Rafael Alvarez? We've covered this on the show before.
He's with the tax magician. Is that who that is?
Yes. The tax preparer, known as the magician, pled guilty to orchestrating a massive tax fraud scheme that defrauded the IRS of $145 million. Operating from his Bronx-based company, A-Tax, Alvarez was nicknamed the Magician by clients for seemingly making their tax liabilities vanish. This is one of the largest cases of individual tax fraud in U.S. history. Over several decades. Go ahead.
You said you've met him before at a conference?
Yeah, he was working with Xero. I think Xero partnered with A-Tax to offer Xero to all of their customers. And so Rafael was at the conferences speaking, and like extremely charming guy. Like, it's strange to have met a fraudster of this magnitude. And I can totally see how his charisma enabled him to do this for so long. But it wasn't sophisticated. Over several decades, he filed thousands of tax returns with falsified information, including fake deductions, business expenses, capital losses, and tax credits, and he secured inflated refunds for his clients. He recruited employees without legal status, intimidating them into participating in the scheme. Some were instructed to impersonate licensed tax preparers using their identification numbers. And when confronted by employees about these fraudulent activities, Alvarez would threaten them and implement policies preventing corrections. So he pled guilty to 1 count of conspiracy to defraud and steal government funds and 1 count of assisting in the preparation of a false tax return. He's going to pay that $145 million in restitution to the IRS. He agreed to do it. Who knows if he has the money. And he's going to also forfeit close to $12 million in fraudulent proceeds. So he facilitated $145 million in IRS losses, fraud, and he himself made $12 million. He is facing up to 8 years in prison and is scheduled for sentencing on April 11th.
And if I remember before we spoke about ATAX in the past, individual franchises were being accused of helping to do questionable returns. It sounds like this is a rolled up, not a conspiracy, but when there's multiple people involved.
I mean, that, yeah.
I know the word. That's
not
what
a conspiracy?
Trump on. They try to get Trump on that. And they get the mob on that. What is the C word I'm looking for? Do you have a?
It's conspiracy, right?
It is conspiracy, but it's not the legal word they use. My goodness, how do they get the mob? They get the mob on that. It's not racketeering either.
Not racketeering? That's a good one. Collusion.
Collusion, that's the one.
Thank you, Rafi. Rafi says collusion. So ATAX was a franchise, but it wasn't the franchisees that got hit with this. It was Rafael Alvarez and his locations. Him. So I feel sorry for the franchisees because now they've got this brand name that's tainted by massive fraud. Oh. All right, David, shall we move on? Or are you gonna? Are you like? It looks like you're like deep into Googling what collusion is.
Yeah, the RICO. They get them on those RICO charges.
Are you sure you're not on drugs for your back? Are you okay?
I'm good today.
Because I don't get to have any pain medication for my hand until I get surgery.
I'm only on Tylenol, which is not a fun drug.
No. I feel like Tylenol doesn't do anything. I don't know. Like
I don't think it does anything either. Advil's so much better. Tylenol's useless.
But you can't take Advil before a surgery. It thins your blood out. All right, what's next?
On a related note, we could pivot over to some other raises. So obviously, we just talked about Bench going away. They're pushing people to that new company, Kick, which is an AI accounting automated startup. There was two other huge raises in our space. So AWIN, if that's how it's pronounced, AIWYN, they raised $113 million to build a client portal, essentially. And then
how much money?
$113 million.
Wow.
So the nice thing is, like, about this is, at least with AWIN, I can tell what they do. On the other hand, there's another company that had to raise Basis. So Basis had to raise, they raised $34 million to create AI agents. And it's not really clear what they do, but let's just talk about AWIN first. So AWIN,
I think it's IWIN.
IWIN. Like, my firm wins.
I don't know.
I win.
I win.
Yeah.
It's AIWYN.
Yeah.
Is there like how to pronounce it in the about page?
I didn't see that.
Go for it. All right.
Are you asking?
Forget it. Forget it. Just keep going.
Okay. So they raised $113 million in funding from KKR and Bessemer Venture Partners to enhance its accounting technology platform. It'll support their goal of evolving its payments and collections suite to a comprehensive practice management platform incorporating artificial intelligence and cloud technologies. So as of right now, the product automates manual payments, collections, and invoices from clients. So essentially, you send your engagement letter, it gets accepted, provide your credit card, they collect the payment, and they're automating that part of your firm. And they've gotten into 130 of the top 500 CPA firms with this software. It's really just revenue management life cycles, essentially what they're in. But what they're going to do,
large accounting firms.
Large accounting firms. But now they want to create a universal client experience portal. So they're going to build a client portal with this money. And they also want to launch an advanced tax solution. So now that they're in with firms, they're discovering these problems firms are having, which we've talked about is clients don't like the portals. Now they're going to go spend all this money on a portal, which I don't know if that's the best use of the money. We'll see how that comes out. But it just feels like a huge amount of money for a company that the problem's already been solved over and over again. This engagement letter, contract, Practice Ignition solves it. I think it's built into Canopy now.
Right, but those are all solutions for small firms. IWIN is focusing, it looks like, on larger firms. And What does that mean? That probably means integrating into their practice management software, their time and billing solution, which does not connect via APIs to anything. There's a lot of value in that, right? Allowing firms to, I mean, in my firm, when I worked at the large firm, we couldn't send an electronic invoice. We had to print them and mail them. That's how old our software was. But we couldn't move off of the software because that's what everyone in the firm used for time and billing.
So I could see that they're working with big firms, they're rolling out their software, and now they're trying to connect it to all these other crappy software packages that are in the firms. And they're like, why don't we just build better versions of this software they're using? And that's the march they're on. So I get that, and I could see that.
Makes sense.
It's a monster amount of money, though.
Mm-hmm.
And
all right, shall we read our second ad, David?
Yeah.
Are you ready?
Second ad is for Shurink. We'll bring up the link here.
Would you like me to read this one, David?
If you want to, that's fine.
Thank you, Shurink, for sponsoring this episode. Juggling dozens of client documents, signatures, and file requests can feel like an endless maze. If you've ever wished for a better way to manage all of this, you will want to hear about Shurink. Shurink is a document management system built specifically for accounting professionals. Imagine having all of your client requests in one dynamic list, updated in real time and accessible by everyone on your team. No more hunting through email threads or wondering if you have the latest version of a document. What makes Shurink special is its ability to automate your most time-consuming tasks. With customizable templates for recurring work, built-in e-signatures, and real-time tracking of every document status, you'll wonder how you ever manage without it. Plus, your clients don't need any special software. They just drag and drop their files, and with a clear audit trail of every action, you maintain complete transparency and peace of mind. Whether it's a massive QuickBooks backup or an obscure compressed file, Shurink handles any file size or type. No limitations, no headaches. Here's what's really impressive. Firms using Shurink report cutting their document gathering time by up to 50%. That's time you can spend actually serving your clients. So, if you're ready to simplify your document management and focus on what you do best, providing top-notch accounting services, head over to accountingpodcast.promo/Shurink. That is accountingpodcast.promo/SURALINK.
And we recently did an Earmark Expo with Shurink, so go check that out. Get in the Earmark app, you can find the expo for Shurink, or on the Earmark YouTube channel, you go to the expos and see the demo there. Super clean app. Very impressed with the demo that we experienced.
The press continues to dig into Billy Long, IRS Commissioner nominee, and ProPublica dug into a credential that Billy Long puts after his name. Billy Long is a certified tax and business advisor, CTBA. You ever heard of that, David?
I've never heard of that.
I have never heard of it either. Apparently, the CTBA designation is offered by a company called Excel Empire, a small firm requiring only a 3-day seminar attendance. I thought it would be interesting to go take a look at this credential, David. I mean, maybe I should consider getting it. I don't know. Let's take a look here.
I'm Matthew Pearson with Excel Empire. I'm excited to introduce you to the Certified Tax and Business Advisor course offered exclusively through Excel Empire. Yes, we can help you differentiate yourself from the over 1 million other United States insurance agents.
That's weird. He says insurance agents, right? Like, I thought that was strange.
To look at what the course has to offer. Realize how you can go and help business owners, investors, those that are selling their businesses for highly appreciated assets, reduce their taxes so that you can come alongside them and help them reach their goals of financial freedom. We look forward to seeing you at our next Certified Tax and Business Advisor course.
And that's it. That video just cuts off on the homepage. So we're looking at the homepage of excelempire.com. The next live and in-person certification is February 23rd to 26th in Southlake, Texas. You can become a certified tax and business advisor like IRS Commissioner nominee Billy Long.
And you get a little badge to put on your website.
I don't know what you get, but it costs you $4,997. Oh, registration is closed, it looks like. But it says registration closes in 18 days. There's a little countdown here on the website, but then it also says registration is closed. It says, interestingly, it says who this is for: insurance agents, financial advisors, and real estate agents.
And what are they teaching in this? Like tricks to like the magician would use to hide some taxable income for your clients?
I don't know. Like what? I'm really curious. Like it doesn't really, it just says, okay, we're going to differentiate ourselves from the competition. And then we're going to learn tax planning, exit strategy, and asset protection. Maybe we'll learn how to file for the ERTC. I'm not sure.
So it's a questionable certification at best.
Yeah, I mean, not very many people have it. It's definitely like just a few. But it's funny, like anybody can create any certification they want, right? So, think about this. Like you spend all this time, years and energy to get a CPA. That means something, right? And then here comes Excel Empire and just creates a certification, Certified Tax and Business Advisor. Boring Accountant says, I will certify Blake and David in professional accounting podcasting after this episode wraps for the low cost of $777. Hurry, hurry, act now. 8 of 10 slots are filled and going quick. Link in the bio. Thank you, Boring Accountant. What's funny is like, here we are the Friday after Christmas before New Year's. And I think this is like the largest live stream audience we've had. I mean, people really don't have anything better to do. All right, accountants. This is amazing. Thank you. And of course, David and I are like totally out of it. Like this is probably our worst episode we've ever done. I feels that way anyway. I don't feel like I'm on top of things.
So there's kind of other news about Billy Long. We got a reporter after episode last week reached out from the Washington Post asking for a link to that podcast episode that we talked about and linked in our show notes because there's some scrubbing going on. They've pulled this down. So the podcast where we played the clip from of Billy Long pumping the ERTC and saying accountants aren't on top of the laws and the code, that whole episode is now no longer to be found on the internet. I had searched temporary folders on my hard drive, cannot find the internet, can't find the file anywhere of that podcast. So there's some scrubbing going on of his peddling ERC that's out there. So if you have any videos of him or podcast episodes, save those off to your hard drive. Don't delete them because I would love to get a hold of the actual original audio files if you have that by any chance.
Media has also been digging into Lifetime Advisors, one of the consulting firms that was doing the ERTC that Billy Long was affiliated with as a salesperson. And I guess it was, New York Times dug into this. And the way it worked is Billy Long would refer clients to Lifetime, and they would prepare the ERTC applications in exchange for a percentage of the tax credit. So like an example would be 20% of the $300,000 credit, and then Long would get a piece of that. Lifetime Advisors helped clients obtain $1.3 billion in tax refunds.
So he got a nice chunk then.
Yeah. Right. If he was getting, I don't know how much he was getting, right? But if Lifetime was getting 20%, what are they kicking over to Billy Long? Now, this is interesting. 2 of Lifetime's leaders, John Lacasse and Jeffrey Molman, they were previously barred from working as securities brokers. I don't know why, but they were barred from working as securities brokers. And apparently multiple CPAs hired by Lifetime left after raising concerns about the firm's tax preparation practices. And there's one story in particular about a nonprofit that received $300,000, but returned it after auditors questioned the claim, stating, and the auditor said that Lifetime's interpretation of ERTC eligibility, quote, borders on absurdity, unquote.
I think that was the claim on the Better Business Bureau that I found when I was doing the research.
Mm-hmm. So definitely like sketchy, very sketchy situation. David, we should probably thank another sponsor, right? We got quite a few sponsors in this episode.
I'm changing tabs now.
This is Cloud Accountant Staffing, I believe. I got the banner up there. You want to read the ad?
Yeah. In case you've missed the last 100 episodes or so, Blake and I have been discussing almost weekly that there's an accountant's labor shortage. Regardless of the root cause, the problem is real. My social media feeds are full of firms attempting to fill open positions on their teams, but how can anyone increase their staff size if everyone is attempting to hire during a labor shortage? That's where cloud accounting staffing comes in. They will help you hire full-time team members for your firm that reside in the Philippines. How much would your firm change, or for that matter, your life, if you could add 40, 80, 120 hours of capacity to your firm in 2025? Cloud Accountant Staffing was founded by a firm owner who grew his firm by using offshore talent, and now he's applying everything he learned to help you grow your firm. If your firm is in need of expert bookkeepers, accountants, CPAs, or virtual assistants, head over to accountingpodcast.promo/CAS. That is accountingpodcast.promo/CAS. Thank you, Cloud Accountant Staffing.
CEO of KPMG, Paul Knopp, wrote an op-ed in the Wall Street Journal that was published earlier this month, December 10th. And the headline is "The Dying Language of Accounting." I saw this and I thought, oh man, they're finally paying attention to this issue that I've been talking about, that accounting is outdated, that it's based in a world of tangible assets, and that we need to modernize accounting to consider intangibles, right? We're too cost-based and all that stuff. Unfortunately, that is not what the article is about. It's good though, but it's not about the actual language of accounting. It's Paul Knopp saying, hey, we've got a decline in CPA candidates and accounting degrees. He mentions the stats we always talk about, that the number of CPA exam takers in 2022 reached a 17-year low. Bachelor's degrees in accounting have decreased over 2020 to 2022 by like almost 8%, continuing a downward trend since 2018. He mentions the material weaknesses that were reported by over nearly 600 U.S. listed companies, and it's related to personnel not having enough accountants, and that municipalities are risking credit rating downgrades due to delayed financial disclosures. And what he calls for to solve this is actually reforming the CPA licensure process, what we've been talking about, eliminating the 150-hour rule or creating alternative pathways, focusing on experience rather than extra academic credits. He does say that salaries are increasing because of this labor shortage, and that starting salaries at KPMG have outpaced inflation. And says the typical thing, which is we need to reposition accounting as not being boring, that's actually an exciting career, which of course
sexy.
We know it can be. It can be. And the CPA opens a variety of doors to a variety of careers. So, I mean, I think it's really great that we've got the CEO of a Big Four firm advocating for change to the 150-hour rule, an alternative. It seems like this is where we are headed. We are going there. It is going to be happening. But I feel like he missed the opportunity there to go bigger. And he didn't really address the major issue that is actually causing accountants to not want to be accountants, or students to not want to major in accounting, right? Which, David, is, do you remember?
The working conditions.
That's right. And in a follow-up, Wall Street Journal posted letters from CPAs. I guess this opinion piece by Paul Knopp stimulated a lot of letter writing, and I've kind of summarized those. And the number one issue that the writers, the actual CPAs who wrote in, cite is the long hours and insufficient pay. The grueling hours required, coupled with compensation that does not feel commensurate with the workload. Several described accounting firms as sweatshops, mentioning that while juniors put in investment banking hours, they don't get investment banking pay. And that's the number one way that we could increase the accounting pipeline is pay people for the hours that they're working, right? Also, the letter writers mention the excessive regulation, the ever-increasing complexity of accounting rules, especially around financial reporting. Examples include lease accounting, changing tax laws constantly. And it means that we're focusing on compliance rather than creating strategic or managerial insight, and that discourages people. People don't want to just be doing compliance with their careers. And I feel like that is a big one. It's like the declining relevance of accounting standards. We have an economy that has changed from being rooted in tangible assets to one that is now, like if you look at the S&P 500 market value, it's almost entirely intangible assets. It's brand value, it's intellectual property. And this is not, on the balance sheet, right? It's very difficult to value these things. So the 150-hour rule is listed as the third most popular item in the letter writers, the one that Paul Knopp highlighted. And then last is the public image, the reputation of the profession is boring or dull. And I've always felt like, well, I say this, David, that it doesn't matter what you do from an image standpoint if the job itself is not satisfying, right? If you make the job satisfying, then the image will take care of itself.
Yeah, because you can make it as sexy as possible and fill the top of the funnel with millions of accounting students. But as soon as they discover the job is not fulfilling, they're not going to stay. So it doesn't matter how sexy we make it if fundamentally the day-to-day of the job is not fun to do.
You can't fix the product problem with marketing. So I think we're making progress, not as fast as I would like, right? We're now, as a profession, we are now over the 150-hour rule, and we're going to find a solution. But what is that solution? We still can't seem to agree. Cal CPA, like we talked about in previous episodes, they came out against the AICP and NASBA's plan to create an overly complicated CPA licensure process. And the Center for Audit Quality has also now come out against that. So we need something. We need an alternative. We need a simplified alternative, and I hope that California will work on that. David,
I was reviewing our stories for 2024, looking at our episodes, just going back in time and reminiscing, if you want to call it that. So in 2024, we had just under 300,000 downloads, 297,422 across all our podcast episodes. We published 51 regular episodes in 2024. This will be episode 52, and 21 bonus episodes we released during the year. And if you step back and think about it more like a narrative or a story, we started out the year talking about the 150-hour rule, and now we're just still finishing up the year talking about the 150-hour rule. But in the beginning of the year, we were really talking about the winds of change have started. Do you remember you brought to the show the paper Arizona CPA Society? And they had a survey that said 80% of the Arizona CPAs supported 150-hour rule alternatives. Do you remember that?
Yeah.
And that was the start of the wave of change for the 150 that kind of kept rolling from the rest of the year that we had. For a lot of the episodes in the beginning of the year, there was about the labor shortage and emergence of AI. That was the first few months. But then the late spring, early summer, we started focusing on the PCAOB fines and audit quality. Do you remember Lyft's typo in their financial statements?
Mm-hmm.
We had the audit quality. And then in March, that was the start of the BOI drama because the Corporate Transparency Act was ruled unconstitutional. But when we really started focusing on the bad audits in April, so episode 379, we titled the episode Get Rich Doing Bad Audits. Mind you, 4 episodes later, the SEC charged Trump's audit firm with a massive fraud, and that was in May. So we were on top of the news pretty tight that we saw these audit failures coming, and they kept getting worse as the year went on and the fines that were hitting firms. But a lot of it was bad quality audits were just out there. And that's really, now in that letter that he wrote, did he address that, or was that in any of the op-ed piece?
Nope.
No,
Yeah.
Nothing about
none of these like root issues, right? These 150 is important, but it's not the root issue. Like people would be happy to do the extra education if the reward justified it. Yeah. But we haven't had salaries go up. They've just plateaued.
Arguably, they've gone down with inflation.
Potentially, depending on where you live, right? With inflation, it may have gone down.
And obviously, we spoke with Trump a lot and on a lot of the episodes, starting with the bookkeeping trial for the hush money. We talked about that was a big story. The election in general was huge. And then wrapping up the year with Doge wanting to build their own IRS filing app and members of Congress asking Trump to kill IRS Direct File. So these are kind of the main themes. It was audit quality, 150-hour rule is changing, and then Trump. was a huge impact on the news for us this year. There's a lot of the episodes. Trying to think of other memories. I think we the bank crash, FTX was in 2023, right? And so was Silicon Valley Bank. I think they were the end of 2023. They didn't happen in 2024, but those would have been stories that would have.
We talked about them in 2024.
We talked about it, yeah, but mostly it was audit quality. I think audit quality really drove a lot of the discussion this year, and it's just also tied to the labor shortage, right? A lot of this and the working conditions.
So getting back to pay, I have a story here that I've been saving for a little while from CFO.com about how much money Americans feel they need to make to consider themselves a financial success. The average American believes that a salary of $270,000 denotes success. But there's a big range among generations. Baby boomers think you only need to make $100,000 in yearly income and have a net worth of $1 million to be a success. So only $100,000 a year. Now, if you take that and you apply that to the CPA profession, to the accounting profession, CPAs make, depending on where they live, six figures, low six figures is on average what a CPA makes. So according to the baby boomer generation, CPAs should be happy. They should be successful, right? And that's kind of what you hear from the, retiring partners who don't understand why people don't want to be accountants anymore. Or not as many want to be accountants.
About how much you need to make to be successful. It's not what do you need to make to just make ends meet. This is a different.
To be successful, to consider yourself a success. Yes. Now, so boomers believe that it's $100,000. Gen Z says you have to make $588,000 a year and have a net worth of $9 million to be successful. So, think about that range. They need 5 times more.
Wildly successful if I was at those numbers.
Right? I mean, that's pretty great. And then, millennials are somewhere in between along with Gen X. Yeah. While high salaries are desired, most Americans prioritize other measures of success, according to this survey. Happiness cited by 59% as the top indicator. It's kind of crazy to me that only 59% of Americans think that happiness is the top indicator of success. So I guess you can be successful but not be happy. I don't even see how that's possible. I mean, I guess we see a lot of that on in TV shows, right? You watch shows like Succession. These are very successful people who are not happy. But I wouldn't want that. You could hand me $1 billion, and if you say here's $1 billion, but you're never gonna be happy, I wouldn't.
What's the point
take
of
the
taking
money
it at that point?
Right. What's the point of taking the money? Free time for personal passions, that's valued by 35% as their top. Physical well-being, 35%. Only 27% consider wealth as the highest measure of success. But again, that's still disturbing to me that you would consider wealth the most important measure of success above happiness and physical well-being and time for personal passions. I don't get it. But if you're in the live stream here and you disagree with me, I want to know why you think, I guess if you're going for the partner track, right, at a traditional accounting firm where you're going to work 60 hours a week for your whole career, then you might be one of those people who values the financial aspect more. Hard work, though, is still viewed as the most critical factor of obtaining success. 84% of Americans believe that hard work leads to success. I think that's a good thing. That's very much like an American attitude. And it's true in my experience. You work hard, generally you'll be successful. Talent, 65% say that's important. Networking, considered by 55%. But, a sad thing about this is that only 47% believe they will achieve their desired levels of success. Yeah. And it actually goes down as you get older, maybe because you have less time to get there. But 71% of Gen Zs are confident and 70% of millennials believe that they will be able to achieve their desired level of success, but it's closer to 50% for Gen X and baby boomers. So
life's easy. It's when you're young, it's easy. It's all upside.
So, let's put this in context, right? Like the average American thinks you need, $270,000 a year in income to be considered a success. Well, we're pretty far off from that in the accounting profession, right? With like, I guess two CPAs together earning an average CPA salary could get there, but you're not going to do it on one. And that's a big challenge because, well, then, raising a family is very difficult. And that's a lot of people have that goal, right? You want to have a family. Hard to have two working professionals working lots of hours, just piecing together the income to be considered successful. What's next, David? Should we talk about intangible assets?
Did you see Walmart was accused of illegally forcing 1 million of its drivers to open bank accounts?
No.
So Walmart has, just like with Amazon Prime, you have people that just deliver goods for you, right? These drivers, they just show up in their car, kind of like they're almost like gig workers or an Uber driver that in between Uber trips, they're delivering a package for Walmart or for Amazon. They're gig workers. Well, the Consumer Financial Protection Bureau is suing Walmart because they forced these delivery drivers to open a bank account in order
to get paid.
In order to get paid, they had to open a bank account through a bank that they called Branch Messenger. So it was a technology company that had the built-in bank account, and this bank would take out fees. So they were extracting low balance fees and just pulling money out, and it basically added up to $10 million in junk fees through this Walmart Spark driving program. So you can basically get the app, sign up to be a delivery driver for Walmart. They force you to get the bank account, and then they put the money in there, and then they slowly extract the money back out of the account. It's like, yeah, at least we're not doing that to accountants that come into firms. We force them to get a bank account at the firm, and then you fee them to death on this. I'm surprised, like, this can't be legal. Or maybe it is legal, but it seems crazy.
Making your contractor sign up for a bank account to get paid by you?
Yes.
Yeah, I don't know. I guess it would be state by state, right? Probably the states set these rules, but it doesn't seem very friendly to them to make them do that.
And I feel like, if I remember correctly, Uber did something like this similar. So when you signed up to be an Uber driver, they would instantly spin you up a Square account, and you're getting paid through that. So I understand the convenience factor of this, but it's questionable at best. Definitely not ethical.
Let's thank our last sponsor of this episode, Tax Bandits. If you're feeling the pressure juggling 1099s, W-2s, and ACA 1095 forms, listen up. Tax Bandits is the solution you've been waiting for. They've got over a decade of experience and support 100 plus tax forms, including everything from your 94X series to those tricky state filings. Tax Bandits handles both federal and state e-filing seamlessly, so you're set no matter how many states your client's operating in. Tax Bandits is IRS certified, meaning they offer instant processing of your forms and provide real-time status updates, ensuring accuracy and eliminating the risk of B notices. For additional peace of mind, Tax Bandits also offers TIN matching and USPS validations to ensure your filings are precise and your IRS requirement is met. Plus, delivering recipient copies is a breeze. Go with traditional postal mail or give clients online access with their forms. It's all about flexibility. As an accounting professional, you'll love Tax Bandits' pro features like a secure client portal, team management tools, and full branding customization. Everything you need to streamline your workflow and provide top-tier service. And when it's late, you're tired, and you need a helping hand, Tax Bandits' support team is actually there via phone, email, or live chat whenever you need them. If you are ready to take control of tax season and join thousands of tax professionals who trust Tax Bandits, head over to accountingpodcast.promo/taxbandits. That is accountingpodcast.promo/TAXBANDITS.
And if BOI is back on again, they offer tools to help you do that BOI reporting for your clients as well. So you can check out Tax Bandits if tomorrow we wake up and you have to do the BOI reporting again.
We got a comment here from the Rogue Independent. Hey, I'm a little late to the stream, but I'd like to get your opinion on OpenAI developing AGI. Do you think it'll affect the accounting profession within the next 2 years? Well, great question, Rogue. The limiting factor in AGI, according to Elon Musk, is power, cost, electricity, which equals cost. It's very expensive to run a model that can think constantly like a human being. You're running prompts, many prompts per second. The human brain is like doing this, like I don't even know if there's like a way to calculate how many times we are running our own prompts in our brains, but it's a lot. It's like, think of hundreds of times a second. And if you're using a giant LLM like what OpenAI has developed, it's incredibly inefficient, and so it's very expensive. So what I'm trying to say is that it's the cost that is a big limiting factor in this. So maybe in OpenAI, they'll have access to this AGI that can think like a human, but it seems unlikely to me that we will have access to it for accounting applications anytime soon. But I do think that AI is going to start impacting us in the sense that we are going to get like chatbots that work like in Microsoft Teams or in Slack, helping us. In a lot of ways, this is going to be like having an offshore team that you talk to mainly via chat that handles tasks for you. It's just the work that is being offshored now is going to be pieced out to perhaps AI instead. And there's a lot of like low-hanging fruit. Accounts payable processing, payroll processing, manual journal entries that need to happen for specific stuff, reconciliations. I really picture yourself, instead of managing like a team of 10 people as a manager in a large firm, now you've got a team of people and AI bots that are doing the work. That's where I see this going
And that's
in
how
the near term.
Basis, who just raised $34 million, that's how they describe their product. The product, which functions like a junior accountant, allows staff accountants to spend time reviewing the AI agent's work rather than doing the work manually.
Right.
So you're right. It's like managing a team or another body, but instead it's going to be an AI agent you're going to manage and supervise the work of.
Yeah, it's like if you write content, if you create content, AI is an incredible tool. You're probably already using it. I don't write anything from scratch anymore. I will talk through what I want to do in voice mode with ChatGPT or in a transcript that I'll then use to create whatever it is I want to create. And it just speeds up the whole process much faster. It's like having a staff writer always available on the team. And you might say, okay, well, what does that have to do with accounting? Well, let's say you've got this journal entry that you have to do every week or every day, and you have like an input spreadsheet. You've got like this report that you get that you have to turn into the journal entry. Well, you can pretty easily train a project in Claude or in ChatGPT now, give it examples of work you've done, tell it what you want to do in the instruction set. And every time you then feed it that report, it'll generate the journal entry. So that's the kind of work that like is getting automated. That would have been incredibly difficult to program, probably not worth it for your company to do that in the past. But now you can basically create that. It's a program, right? It does a specific function. And I've tried this. I've done this with like journal entries. I'll take a payroll report from OnPay, and I'll give it an example of the journal entry that I did, and it'll take the new numbers and plug it in, and it's very reliable. The key is you got to give it examples. So Sean says, always need somebody to run the AI who knows what to do, so it'll automate certain things, but you still need someone who knows what to tell it to do. Yeah, and review the work. It's just like when we had the cloud revolution in accounting, it didn't reduce the need for bookkeepers entirely. Sure, it cut the hours by like 80%, but you still needed people who could do the rest to oversee the work. And those people now make a lot more money operating as outsourced controllers, accountants. It's a great career. It's what I would be doing if I wasn't podcasting. I'd have like 5 clients doing outsourced controllership for, helping them run their payroll, pay their bills, do their books, do the accruals. That would be, fun. I like that kind of work. And, I can automate so much of it with AI now. I mean, that's what Dave and I are doing with the books for our Earmark businesses, right? We don't have to outsource it because we just do it all with tech.
But I stay in the weeds. Like, we should outsource it.
Eventually.
It's really not an efficient use. The only reason we do it is to stay in touch with the apps so we
That's
can
right.
speak intelligently on the podcast. Outside of that, do not recommend doing your own books. You should outsource it to one of our listeners for sure.
I got one final story to take us out. This is about San Francisco, the city of San Francisco, back in the news, overcharging companies for taxes. Remember, we were talking about GM suing the city of San Francisco because San Francisco tried to claim like a share of GM's total like global revenues.
Because GM had a self-driving car division that they bought called
Yes.
Cruise. That's right.
Apparently, San Francisco is doing the same thing to Lyft. Lyft Inc. has filed a lawsuit against the city of San Francisco, alleging that the city overcharged the company by $100 million in taxes between 2019 and 2023. San Francisco calculated taxes based on the total payments riders made for Lyft rides. Lyft says that's wrong because it only recognizes revenue from fees paid by drivers to Lyft, not the full amount paid by riders. Lyft considers its drivers as independent contractors and views them as customers of the platform, not employees. The company argues that driver earnings should not be counted as Lyft's revenue for tax purposes. Lyft takes the fee paid by the rider, passes it along to the driver, and deducts its share of the fee. So Lyft's share is considered revenue in their accounting, and that part that's paid to the driver is not. That's just passed through from the rider.
Usually, sales tax is usually calculated on the total receipts, right? You don't subtract out your expenses. Or if I'm a restaurant and I'm buying tomatoes, I don't get to deduct that first before I pay my sales tax. It's off the top. General,
right. It's the retail price, right? The sales tax. But that's also like sales tax, if you think about it, is sort of similar. It's a pass-through, right? It's paid by the customer, collected by the business, and remitted by the business to the tax authority. It's not revenue to the business.
Exactly.
So Lyft, to support its argument, Lyft is saying, hey, the SEC doesn't consider driver compensation part of our revenue, nor is it recognized as gross income for federal and state income taxes. So apparently only the city of San Francisco is trying to do this. They have not commented. The city has not commented on the lawsuit. And I guess we'll see what happens here. But, San Francisco is really stretching to bolster their tax revenues, it seems, on this one.
And Uber, it looks like, is having a similar battle with the state of Georgia. Basically, the state of Georgia is claiming that Uber failed to collect about $9 million from drivers. Uber should have been taking that.
Because it should have been collecting sales tax for their drives.
It's a similar argument.
Interesting. Little bit more follow-up news. IRS. This is something nice the IRS is doing. The IRS is going to issue special payments to 1 million taxpayers. So be on the lookout, David, for a check from the IRS. I guess a lot of people did not claim the recovery rebate credit on their 2021 tax returns. And the IRS has announced plans to issue automatic payments to those who were eligible but did not claim it. You don't have to do anything. Payments are going to be sent automatically in December and should arrive by late January of 2025. You could get up to $1,400 per individual. And this is a total payout of about $2.4 billion to taxpayers. So again, if you filed a 2021 tax return but did not claim the recovery rebate credit, despite being eligible, you will receive this payment. I'm pretty sure that I claim this, so I don't think I'm going to get anything.
And hopefully you claim this for your clients because they're going to be upset. Why you do this when you filed the return?
No, just tell them, hey, if you get a check in the mail, that's I'll take credit for it.
Yeah, That's because of work that I did or didn't do for you.
Exactly. There you go. All right, David. Well, always a pleasure chatting with you. It's kind of weird always this week between Christmas and New Year's. I'm kind of out of it. I hope our listeners enjoyed this slightly discombobulated live stream. Wish me luck on my hand surgery. David, I hope your back recovers soon. God, we sound like two old partners just complaining about our medical issues. I mean, we're really embracing this vision of the accounting profession here. I forgot to mention that FASB is working on soliciting comments for new treatment of intangible assets. That's exciting. Maybe we'll talk about that next time. Thank you, everyone.
I want to go through a lot of the prediction articles I've been collecting and talk about the 2025 predictions.
Are we going to make predictions for 2025? Is that what we're going to do next week?
We could try.
Did we do it last year? Have we? We've done it every year, right?
We've done it in previous years, though. We're always right. It's just our timing's always off. We're always right about things. The timing's always off on our predictions. That's a problem.
Well, shall I predict the collapse of Bitcoin due to? I couldn't believe this. Okay, so I have been critical of Bitcoin because I say, and maybe this is a stupid argument, but I just say there's never been anything in history that could not be broken from a tech standpoint, right? In Bitcoin, it's called a cryptocurrency because it is based on cryptography. The whole thing works because of cryptography. That you could have a public blockchain that can't be hacked because it's encrypted. Like the keys are encrypted to access wallets and all that. But now Google apparently has come out with a quantum computer that could break all known encryption
in minutes versus years. Some of the
to break some in a reasonable amount of time,
years, right? Decades.
Right. So if somebody figures out how to build a quantum computer like what Google has built, and then applies it to the blockchain to steal people's money, this is why I'm why would we build a global financial system on top of cryptocurrency if that's a risk? There's no people in the loop. Anyway, maybe that'll be my prediction.
The collapse.
I'd like to have a little more optimistic one, but I feel like the next financial crisis is going to be because we end up creating all these derivatives based on cryptocurrencies, just like we did derivatives based on the housing market, and then something goes wrong, and then everything collapses. You actually can see that happening now with Supermicro. Which is the one that's invested in all the Bitcoin?
It's not Supermicro. It's MicroStrategy, I think, is that company.
MicroStrategy. They're borrowing money. They're levering up with convertible notes to buy Bitcoin. So, which then drives up the price of Bitcoin, which allows them to buy more, to sell more convertible notes, to issue more convertible notes, to get cash to buy more Bitcoin. This is where we get into the whole derivative situation where the value balloons beyond what is reasonable. And then it all comes crashing down at some point. But I don't know, maybe I'm way too early.
And people are buying that stock in a way like it's a investment vehicle. This is a way to buy coins and digital assets without actually buying it. Instead, just buy that company's stock, who is very heavily weighted into.
Oh yeah, it's like the whole Bitcoin. Company is just like Bitcoin now, right? It's just a Bitcoin investment vehicle, something like that. All right, David, I will see you here next week. Thanks everyone who joined us live. Don't forget, you can earn free CPE with the Earmark app. You've got a few days left to do it if you have a December 31st deadline. If you want to support us in our work, do subscribe for just a low price of $150 a year for unlimited CPE.
If you're getting any clients that are coming in from bench, they have interesting stories, let us know. Be interesting to keep track of what the downfall of bench really means for the industry.
See you here next week. Bye, everyone.
Bye.